comprehend the effect. If industrial use remains constant while investment interest surges, the value can perform actions that seem unjust. But if investment interest diminishes while industrial interest holds steady, the trading environment can still decrease, just not completely to its starting point. That's how you establish an elevated base gradually. On the production side, the majority of silver output is connected to other metals. That means even if silver values rise, extractors can't immediately increase silver production twofold because silver is frequently a secondary product from extracting something else. That's one explanation for why silver can jump upward in brief intervals. The production reaction is slow. And when individuals debate if $100 silver can endure, this is the actual discussion beneath, not the main news, not the buzz. The discussion is whether the trading environment is moving from spikes driven by investments to fundamental scarcity. If it is, the traditional approach doesn't function identically. But once more, don't allow the overall view deceive you into disregarding the coming days, because trading environments can be fundamentally scarce and still drop 20% in a week if borrowing becomes excessive. That's what renders this instance so hazardous and so captivating. So what does this signify? I'm going to offer you two straightforward models for comprehending today, and I want you to determine which one seems more credible by the conclusion, because both can hold true in various periods, and the distinction between earning profits and getting battered is recognizing which period you're really operating in. First model, the positive perspective, the "this is a breakthrough, not an exhaustion" perspective. If silver can remain over $100, it alters the whole dialogue. Mentally, $100 is a barrier. It's not merely a digit, it's a news generator. It's where occasional funds appear, where trend-following groups take notice, and where industrial purchasers begin calculating uneasy figures on extended agreements. And from a charting standpoint, once you surpass $100 mark, there aren't many close benchmarks. There's no, "oh, we peaked there last year" recollection for the trading environment to depend on. It turns into uncharted territory. That's why you heard discussions about $120 as if it was the next clear target. In graphing terms, it's essentially if we maintain this, the next reasonable level is higher up. But here's what most individuals overlook. The catalyst isn't just a mark on a graph. The catalyst is the economic schedule. This is a week packed with hazards. You've got a key central bank announcement approaching. You've got political discussions about spending plans and closure risks. And you've got another series of news events that can jostle the dollar significantly. And yes, the dollar is relevant, not because it's collapsing imminently, but because brief shifts in the dollar can tug metals around forcefully. The dollar measure fell into the upper 90s, around 97.05 on my display earlier, and that decline can serve as accelerant for metal increases, particularly when traders are already inclined similarly. Now, I'm going to include something here that wasn't in the earlier discussions today. The actual force beneath is the interest rate narrative. When liquid funds feel less secure and fixed income securities feel less reliable, tangible items become more appealing, even to those who aren't fond of tangible items. That change doesn't occur steadily, it occurs in spurts, typically around major policy weeks like this one. And silver possesses an additional factor that gold lacks. Silver isn't solely a preservation of worth narrative, it's a component. It's in gadgets, it's in building systems, it's in the shift to new energy. Based on lately released figures on industrial usage patterns, the interest outline has become less cyclical and more inherently persistent than before, and that is significant when stockpiles are limited and production increase is gradual. So, in the positive model, today's burst is the trading environment probing the upper limit, removing unsteady participants, and preparing for an elevated foundation. In other words, the extension is alarming, but the signal is the trading environment can achieve that height, and now it must determine if it wants to construct a foundation. And if that's the situation, the retreats are not the conclusion, they're the preparation. But here's the suspense. The positive perspective only endures if one particular event occurs next. If silver can cease declining while settling. If trading activity remains high while value decreases, that's selling off. If trading activity decreases and value steadies, that's gathering. Same graph, different implication. And we're going to discover which it is sooner than most anticipate. Now let's move to Model 2, the doubtful perspective, this was an exhaustion and the trading environment just indicated the departure perspective. This opinion states today wasn't sound value finding, it was tension, it was a hedge against, a trigger of protective orders, a borrowing alarm, or some mix of all three. And when shifts like that take place, the value you observe at the summit is not a fair assessment, it's a temporary mark created by sparse available trades and excessive borrowing. Consider what it requires to go from the lower hundreds to $117.84 instantly. That's not an elderly person acquiring a small amount, that's focused activity, large instructions, bold programs, options sellers hedging, and traders following because the graph appeared to defy natural rules. Here's an indicator. The retreat wasn't gradual, it wasn't deliberate, it was fierce, and fierce turnarounds typically indicate someone was compelled. Either those betting on rise were compelled to sell, or those betting against were compelled to cover at the peak, or both. And when individuals discuss viral traders or online frenzy as the cause, I want you to be cautious. That's a simple tale. It's a handy antagonist, but it's also an unthorough reason. Could everyday traders be part? Certainly. Everyday traders are always part when a market goes extreme, but everyday traders seldom initiate the first wave in a market this established. Everyday traders can magnify, everyday traders can follow, everyday traders can contribute energy, but the ignition is usually started by bets, not by a label. A more practical option is this. The trading environment was already tilted, bets against were already uneasy, options risks were already extended, and once value exceeded specific thresholds, automatic buying activated.
Momentum setups purchase when speed signals. Sellers protect when options become profitable. Protective orders activate. And abruptly you have a sequence that appears like unexplained interest, but it's actually a chain of compelled steps. Then, once the pressure reaches a stage where providers of available trades withdraw their offers, the same setups that followed upward can switch to reducing risk, and that's how you obtain the characteristic shift. We observed a towering price bar and then a drop. In this model, the peak mark is the alert. It indicates the trading environment can exceed wildly. But it also indicates the trading environment is delicate, and delicate trading environments can fall further than you imagine, quicker than you imagine, even within a larger upward trend. Now, here's where the doubtful perspective becomes even clearer. Many hear later this year it could be half the value, and they chuckle because it sounds drastic. But if you've examined past silver increases, you know silver doesn't perform mild retreats after explosive shifts. It either stabilizes laterally for an extended period, or it rebounds harshly and erodes your assurance. We viewed variations of this scenario previously. In earlier cycles, silver has had days where it seems invincible, only to spend weeks reversing the excitement. And what that accomplishes is it distinguishes firm belief from borrowing. The commodity doesn't need to fail for the position to fail. Borrowing fails initially. So the doubtful perspective says, don't mix a news mark with a lasting threshold. Don't fix to $117.84 as if that's a fresh base. It might be a burst that fades from your mental recall faster than you anticipate. Here's the next suspense. If this was an exhaustion, you'll notice it in one area before you notice it in the current value. You'll notice it in how the trading environment acts on the next decline. Does purchasing emerge early and composed, or does it disappear until the value is considerably lower? That single action informs you whether reliable participants are collecting or whether all are just awaiting the next alarm. Now, I assured I'd maintain the flow straightforward, so let's return to what you can truly monitor without requiring an advanced system. First, observe the dollar, not as a doctrine, as an indicator. If the dollar gains strength after the policy announcement this week, metals can get hit. If the dollar remains weak, it provides silver space to steady and possibly challenge peaks again. Second, observe rates. If bond returns increase because decision makers appear stricter than expected, silver can get pressured from above and below. If returns decrease because the trading environment detects more restraint, silver gains breathing room. Third, observe fluctuations. When silver swings like this, fluctuations grow. That alters borrowing needs, it alters position amounts, and it alters actions. From the most recent openly available exchange announcements and risk measures, these trading environments can restrict conditions rapidly when things become chaotic, and when that occurs, it can compel individuals out even if they're accurate over time. Fourth, observe the gold to silver proportion. Individuals regard it as a mystical digit. It's not mystical, but it's an excellent gauge. When the proportion falls quickly, it generally means silver is performing the hazardous sentimental portion of the upward shift. That can be positive, and it can also be the final phase enthusiasm. The proportion doesn't indicate direction alone, it indicates strength, and if you desire an additional, very useful indicator on whether this shift has genuine sustainability, observe what transpires in the tangible realm and the basic indicators people employ. When silver is really limited, you'll frequently see tangible extra costs remain high even if the contract value varies. You'll see postponements, limits, or abrupt unavailable notices. You don't need to specify any company to observe it, you just need to focus on the actions. You can also monitor general investment movements. When big groups increase risks, it tends to appear as ongoing purchasing over several periods, not just a lone burst. If today was purely a pressure, you'll frequently see that continuation falter. If today was the start of a fresh stage, you'll see decline purchasing that appears ordinary and reliable. And lastly, observe how extractors and associated stocks respond. Sometimes the commodity bursts and the shares don't verify. That difference can be an alert that the shift is more mechanical than basic. Other times the shares guide, suggesting that informed funds are placing for an extended period. That connection isn't flawless, but in weeks like this, it's another tool in an unclear setting. Now, let me stop and provide something useful. In trading environments like this, purchase every decline is not a plan, it's a phrase. A plan is select thresholds, select periods, and select a risk threshold where you acknowledge you're mistaken. Because yes, declines can be chances, but not every decline is beneficial. Some declines are pitfalls. So here's my inquiry for you, and I want a real response in the comments. Do you believe that $117.84 mark was the trading environment revealing its goal, or was it the trading environment revealing its boundary? And here's a follow-up inquiry, because I'm truly interested in your thoughts. If we end the week still over $100, does that alter your view, or do you still anticipate a more substantial adjustment first? Incidentally, if you witnessed that burst in real time, tell me what you did. Acquired, disposed, hesitated, or observed? Those decisions educate more than any graph today. When silver performs a shift like today, people promptly search for a sole reason. It was this news, it was that statement, it was the closure, it was the central authority. And I understand, we prefer clear reasons, but trading environments don't shift on one factor, they shift on layers of factors. So let's layer them. First, doubt. This week has doubt in several paths: policy, governance, budgets, and the general mood of risky items. When doubt increases, funds cluster into things it relies on or into things it believes others will rely on. That's why you can observe gold and silver rise even when the situation isn't actually crumbling. Second, bets. Silver has a lengthened record of being underheld until it's not, and then it becomes overheld for brief periods. The change between those two conditions is where the spectacle occurs. Third, automatic movements. The contemporary trading environment is not just people selecting manually, it's systems reacting to cues. When a value threshold breaks, systems join in. When fluctuations increase, systems reduce exposure. When options are improperly protected, sellers must follow. Those elements create shifts that feel illogical, but they're actually rules running quickly. Fourth, tangible facts. Silver is not infinite, it's extracted, it's refined, it's required by sectors that ignore your graph, and based on lately released industrial output and manufacturing reports, the draw on silver in specific areas hasn't relaxed the way some assumed it would. Even if investment interest fluctuates, industrial interest doesn't disappear suddenly.
Now, let's question one idea that keeps appearing, the notion that silver only increased because the dollar declined. That's overly basic. If it were that basic, every small drop in the dollar would produce a 15% silver day. It doesn't. A declining dollar can assist, but it doesn't account for the within-day fierceness. The within-day fierceness is about setup, available trades, borrowing, and where the dangers were positioned on the order list. So, if you want to be wiser than the average news consumer, stop inquiring what was the narrative and start inquiring where were the dangers, because today had dangers all over. The danger for bets against was above the earlier peaks. Once value advanced, bets against that were relaxed suddenly weren't. They had to cover during strength, and that purchasing becomes accelerant. The danger for delayed bets on rise was the summit. People acquired the breakthrough late, and when it turned, they were immediately losing. Then their protective orders activated. Then borrowing stress activated, and the selling becomes accelerant in the opposite path. This is why I continue saying silver is an instructor. It instructs you risk control whether you desire the lesson or not. Now, let's talk briefly about the other metals, because they're not just ambient sound. Gold advancing to new records tells you funds are still seeking safeguard, and when gold advances, silver often feels permission to advance stronger. But platinum and palladium getting reduced while silver bursts tells you something different. Not all metals are treated equally. Some of that is bets, some of that is industry story, some of that is just who was packed where. And that difference is important because it can be a signal that silver shift wasn't purely metals increasing, it was silver-specific tension. Now, I know some of you are thinking, so what should I do at this moment? I'm not going to act like there's one solution that suits everyone, but I can inform you what I'm monitoring, and you can apply it to your own circumstances. If silver maintains above $100 through the week and the retreats get acquired swiftly, that supports the positive model.
This was a fierce probe, not a breakdown. If silver drops below $100 and the recoveries appear feeble, that backs the doubtful model. This was an exhaustion, and we're entering a settling phase. And yes, settling phases can still be positive over time. An adjustment doesn't end an upward market. It can actually make it stronger, but it can also ruin the individuals who entered late with excessive amounts. So if you're handling risk, don't handle it with optimism. Handle it with thresholds. And I'll mention this because it needs mentioning. If you're achieving success, share your achievement tale in the comments so others can remain encouraged. People view these videos silently, and they believe they're isolated. They're not. Your tale might be the element that keeps someone balanced. Now, let me expand the view for a moment and provide the why this is significant layer. A one-day burst is thrilling, but what is significant is what it indicates about the wider framework. When a resource like silver can perform this, it informs you available trades are sparser than people presume, and it informs you economic conditions can restrict quickly if the incorrect forces accumulate. It also informs you that price rise mindset isn't gone. Even if official figures settle for a period, the concern of money devaluation returns, the instant policy reliability shakes. And there's another perspective that doesn't receive sufficient focus, the production side. Silver production doesn't increase like programs. You can't just activate more silver. It requires time. Initiatives require years. Approvals require years. Funds require years, and if elevated values are what it takes to warrant new production, the trading environment can exceed before production reacts. That's not a forecast, that's just how resources act. Now, that doesn't mean value goes directly upward eternally. It means swings are part of the deal, and today was swings with the intensity maximized. So, where does that position us going into the remainder of the week? It positions us in a spot where news will attempt to direct your feelings. One source will inform you silver is going to plummet, another will inform you it's heading to extreme heights. Both are offering assurance, and assurance is costly. My opinion is more basic. The trading environment just demonstrated you it can attain $117.84. That is now in the range of potential results. It also demonstrated you it can wipe out a large portion of that shift in hours. That is also in the range. So the inquiry is which result is more probable next. Here's my primary scenario, and I'm stating this as a model, not a guarantee. After a day like this, the trading environment often varies, it vibrates, it attempts to irritate both sides. That's how it readjusts bets. That's how it reduces enthusiasm without crumbling the whole pattern. But there's a hazard too. If decision makers astonish the trading environment, or if there's an unpleasant governmental event, the variation can transform into another burst in either path. And that's why you don't want to be overly borrowed right now, not because you can't succeed, but because the success can become a deficit before you realize. Now, I want to return to the half price later concept because it continues being mentioned and it merits a fact verification. Could silver be significantly reduced later? Definitely. Silver can do that, but half is not a prediction, it's a possibility, and possibilities rely on situations. For silver to be half of today's thresholds, you'd probably need some mix of stricter economic conditions, a firmer dollar, lowered speculative interest, and sufficient relaxation in price rise concerns that people shift back into liquid funds and fixed income confidently. Is that unfeasible? No, but it's also not inevitable. And here's the opposing point that doesn't get expressed sufficiently. If the world is transitioning into an era where industrial interest stays solid, and if the financial setting continues favoring tangible items, then deep retreats can turn into acquisition events rather than pattern enders. So if someone informs you it must plummet, ask them, what's your process? What alters in policy? What alters in available trades? What alters in interest? Because without a process, it's just a feeling. Now, let me provide you a fast conceptual list for the next few periods. When you view the graph, don't just examine value. Ask, is the trading environment creating lower peaks and lower troughs on growing activity? That's selling off. Is the trading environment retreating on low activity and recovering on higher activity? That's collecting. Are we getting large extensions both ways with no advancement? That's uncertainty, and uncertainty usually ends with a fierce shift. And if you're observing from outside, that's okay. Sometimes the wisest position is awaiting clarity. There's no award for being initial. There's only rewards for being sufficiently accurate with managed risk. Now, another fast note before I conclude this. The description includes those additional links, including the premium WhatsApp group and the membership enrollment choice. If you want the extra reports, that's where they are. And again, if you're achieving success, share your achievement tale in the comments so others can remain encouraged. That's not filler, that's group support. Alright, final hint before we conclude this, because this is the portion that will determine what kind of week we're truly experiencing. If silver can recover the mid-110s after this retreat, even temporarily, it informs you purchasers are still bold and the trading environment is not finished probing the higher side. If silver can't even maintain $100 and begins ending below it, it informs you the pressure is concluded for now and the trading environment wants to readjust lower. Either way, today was not ordinary, and days like today are the days you examine because they reveal the mechanics behind the surface. So, tell me in the comments, was today an alert or the initial performance? Press like if you want me to continue monitoring this daily through the remainder of the week, and subscribe if you want more analyses that don't undermine your smarts. And my usual note, I'm sharing my analysis for learning purposes only. I'm not your financial guide. I don't know your circumstances, and nothing in this video is a tailored suggestion to acquire or dispose anything. Perform your own research.